Welcome to the City Different fourth quarter webinar update. Thank you all for joining us today. I'm Michelle Nofel, Director of Partnerships. Let's get this kicked off with a macro overview of the market. We're going to start with Chris Ryan from our fixed income team. Chris, why don't you take it away?
Thanks, Michelle. So to start off with, I'd like to give a quick update on what happened in 2023, then the fourth quarter of 2024, and where we stand today. The economy proved more resilient than many economists had thought. As soon as you get a inverted yield curve, people think you should have a recession within the next 6, 12, or 18 months. That didn't happen. Fourth quarter GDP was 3.3% above expectations. Inflation did come down. The last core PCE measurement, Fed's favorite measurement, is 2.9%, and it was 4.4% same time last year. Unit labor costs are down. We'll get a better picture of that tomorrow. Some of the reasons behind this, although I haven't seen a lot written about it, I believe the fact that baby boomer retirements have impacted the employment picture significantly. Also, the economy has proven to be less sensitive to short-term interest rates. And that's a simple reason of everybody refinanced who could refinance during the pandemic at extremely low interest rates. Think about the homeowner and their mortgages. That's one of the reasons why real estate market is so screwed up. And it also happened in corporate America. Corporate America refinanced their debt, extended it, and raised significant cash. So their sensitivity to short-term interest rates is diminished. Going forward, we're not as optimistic as the market is on where inflation is going to be. It very rarely travels in a straight line. And some of the things that are impacting it is the conflict in the Mideast. One of the major drivers of inflation during the pandemic was the supply chain and how that was disrupted. Well, right now we're finding that container costs of transportation have doubled because of what's going on in the Red Sea. In the third quarter, the U.S. Treasury 10-year reached 4.57% and approached intra-market 5%. It was a 4.92 midway in October. The drivers of that were the fear of Treasury issuance, which they recently announced that Q2 issuance is going to be about $760 billion. That's 6% lower than the October estimate that drove the market higher. Doesn't seem to be that big a deal in my mind. The markets were forecasting a 19% chance of a 1% rate increase in March. And the economic conditions index that Bloomberg publishes was minus 19.19 at the end of October. In the fourth quarter, all that changed. It dramatically changed, especially after the Fed's presser. The Fed hinted at maybe having 3 rate cuts in 2024. The market immediately priced in 6 rate cuts by March. The economic conditions indicator turned around dramatically, reaching 0.86, a positive 0.86 by the end of the year. Markets were forecasting now an 84% chance of a 100 basis point cut in rates through March. That's now 43% of a 50 basis point cut in March, even after the chairman came out and said, that's kind of like a pipe dream. But the 10-year today is back where it finished the fourth quarter, about a 3.88%. The slope of the 2s10s yield curve is still inverted, about 35 basis points. So where are we now? Excuse me. As I said, the 10-year Treasury is at 387. We have a 30 basis point inversion. The economic conditions index is at 0.85% positive. So things are looking up for those drivers of the economy. And the market is forecasting a 250 basis point decrease in short-term rates by June. And they're putting a 111% probability on that. One must think, what's driving that? Could be wishful thinking. It could be, recency bias. We don't believe that that's going to happen. In terms of our total return philosophy, we are still focused on the short end of the yield curve for the 1 to 5 year range. 10-year real yields are positive, about positive 1%. That puts them in the bottom half of the fair range as we calculate it with a standard deviation of or a z-score of minus 0.5. Sorry for those. I am a numbers geek and I always refer to that. So we're focused, overweighting 1 to 5 year ranges. Although the 10-year Treasury looks fair, 5-year Treasury looks even better. And that's the reason we're focusing on that. This week, we're going to have a better read on the economy, and we'll see if we're wrong or right. Like anything, we'll adjust our expectations after those numbers come out. Given all this, Shweta will give a rundown on what we're doing in terms of our municipal SMAs and our taxable SMAs. Shweta, it's all yours.
Thanks, Chris. So to dovetail on Chris's macro commentary, I will start with the credit markets first. So let's recap the fourth quarter for Treasury market, where exuberance for potential Fed rate cut brought on volatility in the form of price appreciations and yields declining in the fixed income market. So yields decreased anywhere between whopping 66 to 76 basis points, depending on the part of the curve you were looking at. And Chris talked about the 2/10 inversion. So for the fourth quarter of last year, that started at 44 basis point, ended at 37 basis point, and currently, I think he quoted 32 basis points. So that's where the yields moved for fourth quarter. Now, moving on to credit spreads. Credit spreads have been pretty healthy. We track the US Ag AAA index versus the BBB index. And for Q4, credit spreads were somewhere around 75 basis points. The reason I bring it up is to juxtapose it against our long-term averages, which for credit spreads is around 163 basis points. So credit's been pretty tight, very healthy, not much to add there. And to recap here, our takeaway on the taxable side is that in Q4, we believe that the market overreacted to a rate cut scenario. And yesterday's comment from the Fed Reserve confirms that the Fed will remain data dependent and measured, and is not as inclined to cut rates right away. And even if they start a little bit later, the easing of financial conditions shows that it won't hurt the Fed. Now moving on to municipal market. So if we have said so far that the taxable markets overreacted, the muni market was that on steroids. AAA general obligation bond yields decreased anywhere between 96 basis points to 115 basis points, depending on the part of the curve you were looking at in the fourth quarter. And remember that for the municipal market, a yield curve inversion is an unusual phenomenon. In the taxable side, we talk about it a lot more. We talk about the 2/10 inversion. So on the municipal side, this is not as common. We've measured the 1 to 10 year curve inversion. And for the fourth quarter, it started at 29 basis points and ended the quarter slightly more inverted at 32 basis points. And not that we measure everything, but we kind of do. This is very uncommon. It's a negative 2.3 standard deviation event. Now moving on to municipal credit. The story resonates from the IG credit market, carries over to the municipal market. Q3 credit spreads were somewhere around 126 bips for the muni market. It ended up in Q4 133 basis points, so smidge wider, but still credit has been expensive. Our comments on duration for munis is that given the current level and the slope of the muni yield curve, we believe that investors are not getting compensated to extend duration or maturities past their 10-year mark. Sending it back to you, Michelle.
Thank you, Shweta and Chris. Now let's move into our domestic equity team update. Rob McDonald, where are you finding value in the market, especially in the U.S. small and mid-cap space?
Yeah, thanks. Within our SMID strategy, we bought 2 stocks in the second half of 2013, and both of them were within healthcare. And so the healthcare backdrop, or the main big story within healthcare this last year was the GLP-1s, or the weight loss drugs. And they should have a big impact on the market, on people's health. And there's sort of an open question of how much that should impact hospital volumes. So the market got very scared, and there's lots of volatility within mid cap healthcare names. So the first stock we bought in Q3 was Sotera Health, and they sterilize medical devices. So if you have a knee replacement, between the factory and the hospital, they'll have to sterilize it before the hospital takes possession of it and then does the procedure. And so they've had actually two issues. One is hospital volumes have been weak recently. But I think it's because of basically a lot of inventory buildup during the pandemic, when it's hard to get a hold of supplies. And so that working down that is what I think most of the volume issue. And then the other issue is they have legal liabilities and higher environmental standards for their products, which will be a cost for them. So that they'll have to spend in the near term. But I think over the medium term, that should increase the barriers to entry and help them grow the market and take price. So this is a great business. It's a duopoly market, and it's very necessary. And so we're excited about this one. And then Stericycle, this is a route-based business. So they do actually two route-based businesses. The first one is they pick up medical waste from hospitals or doctors' offices. And the second one is shred it, which you might know. They pick up documents from offices that have to be shredded and they're confidential. So this is a business that has gone through. It was 10 years ago. It was a great business. It got off track. It acquired all these other businesses, and it kind of lost its way. And so it's been going through about a 5-year makeover. And I think it's finally happening. So it's this great underlying business. If they can get operations back in order, it should be a great business again with great prospects ahead of it.
Great. Thank you, Rob. Let's shift over to our global team. Vin, could you give us maybe an overview of 2023 and talk to us about some areas that you're finding interesting?
I think you're muted, Vin.
Thanks, Michelle. 2023 was a dramatic recovery year in the equity markets, as you all know. Led by again the formerly and now once again predominant technology companies that were leading the charge. We saw for the global index overall, the market was up about 22%. For the year, and for our global strategies, we did finish the year on a high note, and we're real pleased with the news we were able to give our investors for 2023. Some of the themes that were helping us during the year. There was actually several points of strength, but a couple I'll mention. One we talked about in the past is the nuclear power opportunity. And we've talked about and written quite a bit about the global energy transition that our team is following closely. And there's a lot of aspects of that. It's influenced by geopolitics and the war in Ukraine and many factors. But the developments have all been quite positive and encouraging there. We wrote about Talon Energy that we purchased in the middle of last year. That was a strong contributor for us in the second half of the year. At this point, it'd be maybe tempting to declare success there perhaps and move on to something else. But we're still looking at these themes from a long-term perspective, still very constructive about the nuclear energy opportunity nuclear fuel cycle. Still think there's a lot to still play out there and to be that's underappreciated for investors in general. In fact, just this morning there was news about the world's largest uranium producer that announced a big shortfall in its production, about 9 million pounds in a market of 180 million pounds. It's 5%, a really big deal, and I think it speaks to the challenges on the supply side of meeting the world's decarbonization goals and nuclear energy goals for the next several years. So we'll keep following that closely. A second area of strength for us last year was in the insurance space, where we found an investment also over the summer in a niche property and casualty insurance company in Florida called American Coastal Insurance. That was a strong contributor for us as well in the second half. We actually just wrote about this on our blog. A brief synopsis of American Coastal is there if anyone's interested in reading more about that opportunity. From here, I would mention a few things. We're still very focused on the long term. Our portfolio overall hasn't changed a lot. We did make some minor adjustments over the last few months, but it was essentially following and exposed to a lot of the same, we think, interesting ideas that we have talked about in the past. We have a very significant non-US component in the portfolio. Some of our major holdings, biggest holdings are, for example, companies based in Norway, based in Canada. So we think the non-US opportunity is still quite exciting. And in terms of the market overall and market cap dynamics, I would say I think it'll still continue to be a heterogeneous market with winners and losers that are being sorted out in this new interest rate environment. And for sure, in particular in the SMID kind of area, mid cap kind of companies, I see a wide range of sort of quality there. And we think there's some companies that maybe are not so seasoned, and business models not so proven yet. And at the same time, for sure, some hidden gems in those small and mid cap kind of companies. So we keep kind of sorting through all that and looking for opportunities in our portfolios. As usual, we're quite constructive about the coming years. I would say again, it's worth, after such a strong year as we saw in 2023, it's worth kind of taking a deep breath and resetting expectations for the next few years. Realistically at more moderate levels. We'll have our ups and downs, but in general, 2023 was an above average experience, and it's important to recognize that. So you can read more about what we've been up to in a global strategy on our blog with respect to this insurance opportunity I mentioned that we've outlined there. And we also just published our Q4 portfolio manager note there as well, which goes into a lot more detail on some of this stuff. So onwards.
Thank you, Vin, and thanks for reminding everybody about all the content that we're putting out there. Appreciate that. John, could you touch on what you're seeing on the research side?
Yeah, I think it's very similar to what Vin alluded. Like the biggest names in tech are kind of driving so much returns, so they are super expensive. But we are really parsing through a lot of names on the research front, like really looking for under radar names that fits our investment criteria, which is always attractive companies in attractive industry business fundamentals at very attractive valuations. So when we spend day and night just keep looking and looking, and so rest assured we're working super hard for you on the research end. And like Vin said, once in a while we will find something super interesting to do. And so yeah, that's what we do.
Great, thank you. We're going to move into our question section here, and feel free to type in a question if you have one. We have one right now, which actually we've been getting asked a lot by advisors as we've been meeting with them. This is for Chris and Shweta. We're sitting on higher cash reserves in treasuries and money market funds with 5 and 4% handles. How much longer can we expect to hold on to those yields?
Muted, Chris.
We've gotten that question a great deal, and we've written about it. We call it the cash trap. Those 5% yields are very attractive in a money market fund, but the money market funds have on average between 20 and 30 days average maturity. So that when rates drop, those money market funds those yields are going to drop precipitously. One, moderate risk, low risk way to insulate that is to move from a money market fund, move a portion of your assets from a money market fund into a short-term SMA or bond fund. That has a duration of about, call it 1.75 years. A yield will probably be about 4.75%. But in doing so, when rates drop, you're going to have a much more durable dividend stream than you would in a money market fund. And if rates go up, the short duration nature of those assets will allow the yield to adjust higher, so your dividend will grow. We think this is a low risk way to manage the cash trap, to manage the reinvestment risk of a money market fund, and that is an often people don't write about that often, but reinvestment risk is the most significant risk in a money market fund at this point in time.
Interesting. Thanks, Chris. Connor, why don't you take this question? What are your thoughts on the heavy concentration of a handful of stocks within the major U.S. indices?
Yeah, it's a thing. So the Mag 7, which these days we include Apple, Alphabet, Microsoft, Amazon, Meta, Tesla, and NVIDIA, are close to 30% of the weighting of the S&P 500 at year end. You look at long-term charts back 30, 40 years, that is really high. It's around twice the average combined weight of the largest 7 stocks in the S&P over that period. And we saw last year huge returns in the Magnificent Seven, quite a good year for the S&P 500, but much less return contributed by the other 493 names in the index. Vin and I were talking about this earlier. It's an issue globally too. Not quite 30% of the ACWI, but perhaps 20% or so is in these 7 stocks on a global basis. So this is something that needs to be thought about for global investing as well. And it's hard to predict where those 7 stocks will go in the future. Chris says we should exclude Tesla now and make it the significant 6 because they've had some weakness so far this year. Those businesses are profitable. They are growing fast, and they do seem to be positioned to benefit from artificial intelligence, perhaps more than many other names in the index. That said, a lot of that is already recognized in the valuation of those companies relative to smaller companies in the indices. I think the main point is that as you're diversifying your clients' holdings in indices, keep in mind that those indices may not be as diversified as you think, given the large weight in all of those holdings. One last thing I wanted to mention. I'm having a really good time traveling all over, meeting with especially RIA founders, owners, advisors. I want to make sure that you guys use me as a resource. It's a big focus of our business at City Different. I'm in the flow on a lot of issues that RIAs are facing, and I'd be super happy to be a resource on any questions that are coming up for any financial advisors, any RIAs, as you're thinking about where your business goes in the future. It's been really fun connecting with owners and thinking about the future of their businesses, and in certain circumstances helping with our solutions here at City Different.
Great. Thanks, Connor. So that concludes our question section. So, we try to strive to keep these calls to 30 minutes, and we're getting there to that mark. So I'll go ahead and wrap up. As a reminder, for additional information from our investment team, you can always subscribe to our blogs, as well as our fixed income week in review, and that can automatically go into your inbox, and you can hear the latest and greatest from our investment team. So thank you all, everyone, for joining us today, and we look forward to hearing from you. Thanks so much.